Absolutely delighted to welcome you to this AIC Investment Company Showcase today. This is our third showcase and we've got over 30 fund managers from all over the world presenting. Right, let's get on with this presentation. Our first speaker is from Syncona, whose purpose is to extend and enhance human life. Syncona have a really unique proposition in the investment trust world because they create and build companies to deliver transformational treatments in areas where there's a really high need. So I'd like to introduce Chris Hollowood, who's the CEO of Syncona Investment Management, who's presenting to us today. Over to you, Chris.
Terrific. Well, thank you very much. Well, thank you, everybody. Thank you for sparing the time to listen to our presentation today, and thank you to the AIC for the invitation to speak. I'm going to talk a little bit about Syncona, but first I'm going to talk about the healthcare market and the opportunity to invest generally in the healthcare and why Syncona is a good place to do that. So the fundamentals of investing in healthcare are very strong. They're driven, actually, by the number of people aging. About half of healthcare spend is spent in the last year of life, and we have an aging population across the Western world in particular, but not just the Western world, parts of Asia too. And there are 1.6 billion people projected to be over 65 by 2050. That is going to drive the need for healthcare. And the provision of healthcare solutions to these people is innovation. So the beauty of healthcare is it's not cyclical, it's driven by the innovation going on in the universities that then become experimental products and taken through the cycle to move it all the way through to a drug approval and then to patients. It's not working down there.
I'm just going to say we haven't got any counting down up here.
And the slides aren't moving, but yeah, we shall carry on. So the healthcare industry has been through a number of big shifts. So back in the 1950s was what we've characterized, what we've characterized as the first wave. The first wave is the set of medicines that are small white pills that you take with a glass of water, the penicillins of the world, paracetamol, those drugs, they work very well, but they are limited in the number of biological targets they can get to. So they capped out in the number of opportunities you could pursue with them. Then there was a second wave, and actually the UK was at the forefront of that second wave, which was large molecules, and particularly antibodies. If you have relatives that have been unfortunate enough to have cancer, they will go in and have infusions at the hospital. Those infusions are of antibodies, and these are very precise molecules that hit particular targets, and they move the whole industry on again. And then at the beginning of the 2010s, again, with the UK at the epicenter of this innovation, came the third wave. And the third wave was gene therapy and cell therapy and gene editing. And this is using very complex biological modalities to deliver real precision hits against disease. And again, the whole industry moved forward. Today, we're at this wonderful position where all of this is coalescing, where you have a whole heap of different ways to make drugs, correlated against loads of different ways to discover what the right biological target is. And the matching of what we've described as the target, the biology you want to hit, the modality, how you want to make that drug, a cell therapy, a gene therapy, an antibody, or a small molecule, to hit a disease is actually where the next 10 years is going to be, and Syncona's at the forefront of that. There's no back button here, so I'm very nervous about pressing it twice. The flip side of that wonderful opportunity is that drug discovery is a very long and precarious process. And that's why we have a portfolio, because any one drug might not make it. And we have what's on here is the industry averages. This is not what Syncona does. We aim to go faster and better than this. But the industry average is about 12 years to get from an idea to a drug approval. For every 10,000 ideas, one drug. One drug. For every 5 ideas that go into the clinic, that's when it really counts. So now you've actually started testing on humans, you get 1 drug out of those 5. So it's when you get in the clinic that rubber really hits the road, but the odds are still 1 in 5. So you need to be really smart about which ones you pick, and you need to run it across a portfolio. Pharmaceutical companies have portfolios of drugs that they're developing. We Syncona have portfolios of companies that are developing several drugs for that reason. The beauty of it, though, is if you get one right, they're worth a lot of money. These drugs, and we've got some examples later, sell in multiple billion dollars per year. So although it is an arduous journey, the reward at the end is very big. And whilst the fundamentals are strong, it's not moved again. Whilst the fundamentals are strong, the dynamic in the market is strong as well. So those pharmaceutical companies with their $1 billion of revenue are only allowed to sell these drugs at a premium whilst they're on patent. And when they come off patent, generic companies move in or biosimilar companies move in, they produce the same thing at a much lower cost, and all of that revenue dips. So they need to constantly fuel their pipeline with innovative new drugs that they can charge at a premium. If you talk to any pharmaceutical CEO right now, he or she is panicked about the second half of this decade because there's $331 billion of revenue coming off patent. So they need to fuel their pipelines with new innovation to drive that growth. And you can see that if you build a biotech company that gets into clinical trial, you don't even need to get to the end. You don't even need to get to the product approval. You've got to get into clinical trials and show your drug works in humans. You can sell that company for a very, very large number, billions of dollars in some instances. And pharmaceutical companies are increasingly reliant on the biotech market for the innovative new drugs. And that's what Syncona does. We provide those companies that then get acquired.
Okay, I'm just going to say that the slides are not working here.
Back on top. There we go. Now, we've been through an incredibly challenging market. I think that would be no surprise to anyone in the room. When cost of capital goes up, industries with the longest dated cash flows get hit the hardest. And the riskiest, long-only industry to be in is biotech. So we've been in that over the last 36 months. And essentially what happened was, obviously we had a pandemic. The central banks dropped interest rates to the floor. That piled a whole heap of capital into the market, and it went after the risky end, which was biotech. And that drove it all up. And then the flip side just happened as inflation came through. So we've been through nuclear winter in our sector. And the job in nuclear winter is to preserve the value in your portfolio so you have a strong platform for growth when growth returns. Talked of the fact that we believe we built that strong platform, but I'm optimistic that growth is about to return in the biotech industry. We all know inflation is coming down, which is the top right chart. Do not underestimate how much that is rocket fuel for our sector when cost of capital comes down. And you can see it. So in the bottom right chart, what you have is the listed biotechs on NASDAQ. NASDAQ is the big US index where the innovative companies tend to list by stage. So those clinical trial stages. So preclinical means I've not yet tested it in a human. Phase 1 means I'm testing it in healthy volunteers. Phase 2 means I'm doing my first exploratory study in a patient. And phase 3 means I'm confirming that it works before I send it all into the regulator for approval. And you can see the re-rating of values. So the bars are from June 2022 through to September this year. And you can see as particularly late stage, so I'm going to point now, particularly late stage, those values have started to really come up. The reason the green bar looks higher than the September bar is because so many of those companies got bought by pharma, so they've been taken out of the index. And then you can see in the phase 1 and phase 2, those valuations are starting to come up. The beautiful thing about investing in Syncona is NASDAQ is our leading indicator. So you can see what NASDAQ is doing and then work out where our portfolio will go. So when stock markets started coming down, Syncona was 6 months offset by that. They've started to come up. The last quarter was the first quarter over the last 2 years where biotechs outperformed tech on NASDAQ. So they've moved, we've not yet moved. Now, the reason Syncona does what it does is we sit in a fantastic ecosystem. So the UK, I think everybody would have heard that the UK is a powerhouse of research. It's absolutely true. We have some stats on the slide here. The one I always like to give is there's only one place on Earth that you could be 60 miles from four of the top 10 life science research universities. That's London. It's not Boston. It's not San Francisco. They might have bigger biotech clusters, but it's here. That's Imperial, UCL, Cambridge, Oxford. We should be very proud of that. That's the lifeblood of everything we do. When I have US people come and visit us, they always ask me, well, you've run out of good ideas to invest in? No chance. You know, there is about 1/10 of the people chasing good ideas on this island as there are in Boston, and the number of ideas is just as good. So we're never going to run out of that rich seam of ideas. What we need is the capital to scale the winners. That's actually the risk that we face when we get a good one. And this isn't a new thing. This track record has existed for a long time. Humira, the world's biggest selling drug, sold $14.4 billion last year, $14.4 billion in a year. That was invented in Cambridge by a company called Cambridge Antibody Technology. That then got sold to AstraZeneca, but unfortunately before it sold itself to AstraZeneca, it licensed the product out to AbbVie. Another example of great innovation with great commercial potential, not going the distance on this island to get sold out to America. That's what we're trying to stop. And that keeps going. A drug called TrueCap got approved in November last year, so it's not yet been on the market a whole year. That was developed at the Institute of Cancer Research down in Kensington. So that innovation is just ubiquitous through time on this island. And that's what we're seeking to exploit and what the Wellcome Trust saw when they set us up. So we were founded by the Wellcome Trust in 2012. And then in 2016, we listed on the London Stock Exchange. And the thesis is that if you can connect that world-class science to that drug approval by building a company that has the operational capability to do it and the capital to get there, you can drive a lot of value. And in our history, I'll come to it at the end, in our history, we've shown that model works. We've shown the right. The key to that, if you go back to those drug development timelines, is you need the time to do it. And that's why the balance sheet that being a listed company affords us is absolutely key to driving that model, and is not a capital structure that most people doing my job have. Most people doing my job have got about a 6 to 8 year window to do it. And it doesn't match the development cycle in our sector. That's why we're uniquely positioned to exploit it. So we focus on creating companies around world-class technology. You know, when we sit in our investment team meetings, the mantra is don't do anything boring. Just make sure you're at the frontier each time. Frontier innovation drives high patient impact, drives value. Quite simple. Hard to do, but quite simple to say. We're building a portfolio of 20 to 25 companies. It's a slow process. In the first 10 years of our existence, we did 2 companies a year because we build them ourselves. They're handcrafted by Syncona. They're not things that walk in off the street. And we do that because we don't believe that the ecosystem provides us, management teams, and strategies and business plans that will have that technology beat the American equivalent. So we go in and we make sure that we do it. Again, when we talk in our investment meetings, we always talk about if you're going to send a rocket to the moon, you've got to at least point it at the moon. So that's what we do. We've upped that to 3 a year since I took over at the beginning of last year, and we're driving towards that 20 to 25 companies. Within that set, if we get 3 of those, we're going to look really good. If we get 5 of those, we're going to look fantastic if they get themselves to market. That's what we're aiming for. And we have shown it worked. So in the first 10 years, the aggregate exits that we have had in our businesses are nearly £1 billion. Those exits are just under 4 times cost. And the rest of the portfolio sits there with its latent value, with every bit the potential to replicate what we've done historically. but we need to drive it forward. So the model, as I said, we go find a professor, we talk to a professor about what he or she has been working on for the last 10, 20 years, and we find within that the most special thing, and then we put strategy, business plan around it for high patient impact. At that point, we have CEOs that work for Syncona that can drop in and they can run that company for us, and that buys us a 24-month time span where we can hire in an autonomous management team. At that point, we step back, stay on the board, stay as strategic advisors to the company, investors in the company, we help that company scale. If you get all of that right, then you can take a company like Gyroscope, which started with a meeting between me and a guy called Professor Sir Peter Lackman. He'd worked on a part of your immune system called complement, which you may not have heard of, but it's the first line of defense in your immune system since the 1970s, and he discovered a protein in it called complement factor I, fractionating blood in Hammersmith Hospital in the 1970s. But no one had ever been able to make it. So he had this wonderful idea of how you could impact part of your immune system, but no way to develop it as a drug. Then I met with him and spent a lot of time trying to understand the system he was explaining to me, and we came up with the idea that actually if you use gene therapy, you can use the body to make that drug in situ. So that's what, that idea didn't exist. The creative force of that idea was Peter Lackman and Syncona meeting. We filed a patent, Syncona, Cambridge had a patent, and that became the formation of Gyroscope. Wind the clock forward 6 years, that got sold to Novartis for $800 million from that idea. That's what happens if you follow this process. Okay. This is the portfolio we built. This is as late a stage of portfolio as Syncona's ever had. If you go back to what I said at the beginning, the value all happens at the end when you get close to that product approval. Everything above that blue line here has got phase 2 data, has got data in humans showing some sign that it works. So the potential for these businesses to M&A is quite high. And what we've got to do is we've got to keep progressing them and wait for the phone to ring from a big pharma, and they'll buy one of these. Below the blue line, those are exciting new companies that we're putting in the ground now that will drive up and they'll fuel growth beyond that 24-month horizon where those top 5 deliver. It's diversified across therapeutic area and stage. So we're in oncology, ophthalmology, liver transplant, kidney disease, heart disease, lots of different areas. So investing in Syncona, you're not putting all your eggs into one basket in a particular therapeutic area. And you're not putting all your eggs into one basket with a particular modality. Remember at the start, I said there's lots of different ways to make a drug now. We exploit them all. We have cell therapies, we have gene therapies, we have small molecules, we have biologics. And that gives us a rich set of what we call key value inflection points coming up. These are data readouts that are going to tell us whether our company has a drug that works. And if it does work, we're going to hugely de-risk those companies and drive value. That key value inflection point will either allow it to raise the money to get to the next point, or be a sign that someone wants to come in and buy it. Can't guarantee M&A will happen. You never can. But what you can guarantee is you deliver enough of those, it will happen somewhere. That's the point of a portfolio. One of our most advanced companies is a company called Beacon. This is in an area of blindness called X-linked retinitis pigmentosa. So this is a form of blindness that boys get where they're missing a key protein that helps your rods and cones function. If you remember your GCSE biology, those are the photoreceptors at the back of your eye. So what happens with these patients is that their rods and cones die from the outside of their eye in. So what they notice is in their teens, they lose their night vision. And then through their late teens and 20s, they'll get a gradual closing of their visual field, which is depicted up on the left here, to eventually in their late 30s, early 40s, they'll be legally blind. There's no drug on the market for it. Nothing can stop it. Can't slow it down. It's a horrendous disease. So what we did is we developed a gene therapy So they're using a virus called an adeno-associated virus, which none of you will have heard of, but 50% of the people in the room will have had, because it's asymptomatic. And what you do is you take the gene out of the virus and you put in a working copy of the gene that these patients are missing. And then, if you're squeamish, put your hands in your ears, you inject it underneath their retina. So you do a surgical procedure, inject it under the retina, and then that virus takes that piece of DNA into the nucleus and it makes the missing protein, and you can see that on here. So if you look in the top left, this is what's known as a microperimetry plot. So when you look into a machine in the optometrist and it fires a bit of light at you and you press the button when you see the light, what it's doing is mapping the sensitivity of the back of your eye. So most people's eyes in this room, all of that would be green. So this patient is very profoundly blind. You inject it, and you can actually see that the surgeon came in from the bottom right side, because you can see where it's gone. The visual field of that patient is hugely improved, and you can see in the center they've turned from reds to yellows, and there's even a green in there. So the acuity of that patient's gone up hugely. This drug really works. It's in phase 3, so we need to do the last study before we can then file it with the regulators in 2026 and get it approved. But we're very excited by this. This company's more advanced now than Nightstar, a company we had about 6 years ago, was when it was sold for $800 million. This company is more advanced than a company we sold for $800 million. And we own 40% of it today. The team we have is able to scale this business. The first 10 years of our life, we had a different model and a different team, and that delivered us from about a £200 million business to about a £1 billion business. We need different skill sets, different processes in order to scale from £1 billion up to 5, which is our target. And we put all of those in place over the last 24 months. So we're emerging from this bear market with a portfolio in really good shape, lots of late-stage, high-quality opportunities, and a team that can really drive it. So the takeaway, fundamentals in the healthcare sector are strong, always are strong. But the dynamic in our industry is moving much more in favor of the people that own the biotech companies relative to the pharma companies. The pharma companies are losing revenue that they need to replace, and the biotech companies own the assets that can replace that. So we're in a very good spot if you're the owner of those businesses. And that's exactly what Syncona does. So we're listed on London Stock Exchange, 1.2 billion net asset value, and market cap much lower than that. I'm sure people have some questions on that. But the latent value sat in our portfolio now is akin to the latent value that we had when we first listed back in 2016, 2017. That maturing portfolio, we believe, will drive that near-term growth. And those new interesting things that we're putting in the ground will then drive the growth beyond that in a sustainable way. We've got a target to get to 5 billion by 2032. We feel we're on track for that. In a bear market that went down 40% top to bottom, our NAV went down approximately 10. So no one wants to lose money, but to preserve that amount of value in your portfolio in the biotech sector through a bear market is testament to the team at Syncona and what they did. What that means is we're now emerging into a better market, growing from a 1.2 billion base, not from a 900 million pound base. So I think I've left time for questions.
You did. Thank you very much. I'm wondering now if we can take any questions. We've got some people wandering around here with roving mics. I'm going to try and move forward. Do we have any? Yeah, we have a question over here. We've got one over here. So we'll go to this gentleman here on the left.
Hello. Do you see any opportunity in that sort of research, sort of long research process for AI to accelerate that at all? I think you had something question on that at some point.
Yeah, so I think AI will have an impact, but probably not as big an impact as a lot of people think. Ultimately, I can't see any regulator allowing a drug to be approved that's not been fully tested in humans, and AI can't do that for you. So that big part that's quite time-consuming, a lot of money, I don't think you can do a huge amount with. What I think it can do, though, is that research bit at the beginning, where the amount of data that some of the research tools that we now have can produce is profound and beyond the capability of humans to sift their way through it. And I think AI can do that for us really well. And I think in doing that will allow us to have much better hypotheses that we want to test when we take it in the clinic. So where I think it will have a really big impact, I think it'll speed that bit up a bit, but that 1 in 5 going to the clinic that gets it all the way to the end, I think that could become a 1 in 4 or a 1 in 3 as a result of AI. So I don't think it's necessarily speed, but I think it's the risk taken out the process. So we're optimistic about that. We have 2 companies that are using more machine learning, but 2 companies that are using it for that very reason. Yeah.
Thank you. And another question right here. There's a microphone coming to you.
Okay. So, with Beacon, you said you own 40%.
Yeah.
Who owns the other 60%? And could you compare that with the gyroscope position when you exited gyroscope?
Yes, so the other 60% is owned by other venture capitalists, a group called Forbion out of Amsterdam, a group called TCGX out of San Francisco. So it's a global syndicate of investors. We did all of this, what's known as the Series A, the first financing round, so we owned almost all of it at that point. And then we recently did another financing round to give it all the money to get to a product approval. And I've been doing this 20 years. I don't really recall a situation where a European biotech has managed to raise all the money to get a drug approved. So this is a company that could get a drug approved without going to NASDAQ and take the dilution of that, potentially, when we rule it out. Gyroscope, we were 55%. At the point of exit, give or take. I need to get the exact number, but it was sort of that level. Again, we've done all of the A and the B there, and then we brought someone in at the C that taken us down to 55%.
Okay, do we have any more questions here? There's, okay, quick. There we go. Thank you so much.
Good morning. Okay. First of all, are your slides going to be available on the website?
I think this is totally going to be recorded, so it's going to be available on the website, yeah.
Good,
yeah.
Thank you. They're very useful. I did want to ask, how much is Syncona using AI to push forward that first research phase? And what success are they having with it?
Well, so it's early days to call it successful yet. But we, as I mentioned to the prior question, we have 2 companies that are using it. I'm not sure how long I've got to answer questions. I could talk forever about it.
You've got 2 minutes.
So we have a company, I'll do this in 30 seconds, we have a company that we just spun out of Oxford in acute myeloid leukemia. So it's a horrible form of leukemia. You get what's known as a stem cell transplant to cure it. And it cures 30%, kills 30%, and 30% it doesn't work. And you get it at the very end stage. Brilliant professor up there, SVS, has kept all the blood samples of everyone that's had their stem cell transplant taken at the John Radcliffe. And within that, he's found 15 patients that got a cure and didn't get what you always get as graft versus host disease, because what normally happens when you put someone else's immune system in, it kills all your healthy tissue as well as your cancer. You're just hoping it kills the cancer faster. So it's profound that no healthy tissue was hit. So in those 15 patients, what it means is he's found a target on a cancer cell that doesn't sit on a healthy cell. What it also means is in all those other patients where they did get graft versus host disease and you can't find those targets, they must exist. That's a machine learning experiment to find them, because you've got all the genetic data. So we have a mathematician in that research group doing exactly that.
Thanks very much for your question. I can see there's just one last question, and we have literally 1 minute, but we want to take it. Go ahead.
Very quick question. I'm sure the discount on the shares is a source of great frustration to you and the board,
yes,
and clearly to us who are shareholders. Could you just talk briefly about the capital allocation policy and the thinking behind that? And because clearly you're trying to do something about it.
Yeah. So obviously we have a buyback ongoing. We have also, since I came in last year, really push the capital we're allocating to those later stage opportunities, the ones that are more proximal to M&A, so that we can get nearer NAV uplifts and potentially some liquidity through that. And that meant a lot of consolidation of some of those early stage businesses to remove the burn from there. What we said is that in the event of another exit, that we will look at the circumstances at the time and look to return capital. We've got excess capital. We'll do that in consultation with shareholders as to what the right way of doing it. But I think you can feel assured that if we get another big profitable exit, that we will return some capital. What we don't want to do, though, remember the KVIP slide, we have to fund those. Unless we fund those, we're going nowhere. So we've got to make sure we've got the capital for that. And the cardinal sin in this sector is running out of money. These are not revenue businesses. If you run out of money and can't support your businesses, some other investor will come in and cut you off at the knees. So we've just got to avoid that, because that would be a disaster for our shareholders. But we understand the balance and are very, very thoughtful about it.
Well, I'd like to thank all of you for your questions. I'd like to thank Chris. It's an incredibly, as I said, unique proposition in the investment trust industry, going out, finding the need, founding the company, developing it, and exiting. And I think it's been an incredibly interesting presentation. So thank you so much.
Super. Thank you.